Hello everyone. For the first time in over 20 years, Chinese importers have placed zero new crop orders from the US during the crucial autumn harvest season. This abrupt halt in demand from what was once their largest customer has sent shockwaves through rural communities. The economic impact has been swift and severe. U.S. agricultural exports to China are projected to plummet to just $9 billion in 2026, the lowest level since the 2018 trade war and a staggering 50% drop from 2022 levels. Soybean farmers are bearing the brunt of this collapse. Price collapse. New crop soybean futures saw sharp declines, with farmers in states like Illinois facing estimated losses of up to $64 per acre. Export plunge. From January to August 2025, U.S. soybean exports to China fell to 218 million bushels, a dramatic decrease from 985 million bushels during the same period in 2024. By value, shipments sank 51% to $2.5 billion in the first 7 months of the year, mounting surpluses. With their primary market gone, farmers are forced to store massive quantities of harvested soybeans in bins and silos, hoping for a market resolution while incurring significant storage costs and the risk of spoilage. This financial strain is rippling through the entire agricultural economy, affecting everything from the sale of tractors and farm equipment to the stability of local businesses that depend on a healthy farm economy. Many farmers, already operating on thin margins after years of high input costs, now face the real possibility of bankruptcy. This crisis was precipitated by a significant shift in U.S. trade policy in 2025. The Trump administration imposed a series of broad and aggressive tariffs, including a baseline 10% universal tariff and specific 25% tariffs on goods from major trading partners Canada and Mexico. These actions were publicly justified as leverage to combat issues like fentanyl trafficking and to correct perceived trade imbalances. China's response was predictable and strategically targeted. Beijing retaliated with its own set of tariffs aimed squarely at politically sensitive sectors of the U.S. economy, with agriculture at the top of the list. By imposing a combination of retaliatory tariffs and other duties, China effectively raised the tax on U.S. soybeans to 34%, making them uncompetitive in the Chinese market. A fundamental misunderstanding or misrepresentation of tariff economics lies at the heart of this policy. Despite claims that foreign countries would pay the tariffs, numerous economic studies, including analyses of the 2018 to 2019 trade war, have concluded that the costs are almost entirely borne by U.S. importers, and ultimately, American consumers and businesses in the form of higher prices. The 2025 tariffs are projected to reduce U.S. GDP by 0.8%, raise consumer prices, and amount to an average tax increase of $1,600 per U.S. household in 2026. The strategy of imposing tariffs with the expectation that a trading partner will concede, only to have them retaliate against your most vulnerable export sector, is a textbook example of a self-inflicted economic wound. China's choice of soybeans as its primary retaliatory weapon was no accident. The crop sits at the nexus of U.S. economic and political interests, making it an ideal tool for applying pressure. For the United States, soybeans are not just another crop. They are regularly one of the nation's most valuable agricultural exports, with a total export value of over $30 billion in fiscal year 2024. Historically, China has been the single largest buyer, purchasing roughly 60% of all U.S. soybean exports, a market that is now gone. Furthermore, the key soybean-producing states in the Midwest, Illinois, Iowa, Minnesota, Nebraska, and Indiana, represent a crucial political constituency for the Republican Party. By targeting soybeans, Beijing aims to inflict maximum economic pain on a voter base that is politically important to the Trump administration. For China, a stable supply of soybeans is a matter of national food security. The beans are a primary ingredient in animal feed for its massive hog herd and a key source of cooking oil. The trade war has forced China to accelerate a long-term strategy of diversifying its agricultural imports to reduce its strategic vulnerability and dependence on the United States. This is not merely a short-term negotiating tactic but a fundamental realignment of its supply chain. The data clearly illustrates this strategic pivot. As U.S. exports to China have collapsed, exports from South America have surged to fill the void. Trade flow comparison Jan-August 2025 vs. Jan-August 2024 U.S. soybean exports to China, down from 985 million bushels to 218 million bushels. Brazilian soybean exports to China, approximately 2.5 billion bushels during the same 2025 period. Argentinian soybean sales to China, over 2.5 million metric tons sold in a brief period in September 2025 after Argentina temporarily suspended its export tax. This demonstrates China's ability to leverage its immense purchasing power, effectively turning global agricultural markets on and off like a spigot to achieve its geopolitical aims. The realignment of the global soybean trade has created a clear set of winners and losers. The winners, Brazil and Argentina, are the primary beneficiaries. They are capitalizing on the U.S.-China dispute by securing long-term supply contracts and ramping up production to meet Chinese demand. Brazil is now on track to produce 42% more soybeans than the U.S. in the current marketing year, cementing its position as the world's new soy capital. The losers, U.S. soybean farmers, are the undisputed losers, facing what the American Soybean Association president has called overwhelming frustration. The damage extends across the U.S. agricultural supply chain, from equipment manufacturers like C&H, which saw a 20% drop in agricultural business sales, to local economies in the Midwest. The contradiction, in a move that has baffled and infuriated U.S. farmers, the Trump administration is simultaneously negotiating a multi-billion-dollar financial aid package for Argentina to help stabilize its economy. This means the U.S. government is preparing to use taxpayer money to support the very country that is directly profiting from the administration's own trade policies. As one U.S. senator questioned, why would USA help bail out Argentina while they take American soybean producers' biggest market? This policy appears not just counterintuitive but absurdly self-defeating, effectively subsidizing a competitor in a trade war of one's own making. The immediate financial pain, while severe, may be overshadowed by the long-term strategic consequences of this trade conflict. First, the U.S. is facing the permanent loss of a significant portion of its largest agricultural market. China's pivot to South American suppliers and its focus on domestic food security is not a temporary measure. Beijing is actively solidifying new, more reliable supply chains, and once these trade relationships are entrenched, it will be exceedingly difficult for U.S. farmers to win back their lost market share. The U.S. is increasingly viewed as an unreliable supplier. Second, the administration's chaotic and confrontational approach to trade is eroding global trust in the United States as a predictable and stable partner. The willingness to use tariffs as a cudgel creates profound uncertainty for businesses and investors, making future trade negotiations more fraught with difficulty. Allies and adversaries alike are learning that exposure to the U.S. market has become a liability, prompting them to forge new trade blocs and agreements that exclude the United States. The path forward is fraught with peril. While the U.S. government has promised another round of financial aid for farmers, this is a short-term patch on a deep structural wound. Such programs are unsustainable and do not address the underlying loss of competitiveness and market access. The 2025 soybean standoff is more than a dispute over a single commodity. It is a stark illustration of how protectionist policies can backfire, creating economic hardship at home while empowering strategic rivals abroad. The world is watching as a decades-long agricultural trading relationship is dismantled, and the U.S. risks trading its long-held market dominance for a harvest of uncertainty. That's it for today. Thank you for watching.